Great to have you on the program. The first question I think that is on everyone's mind here is, are we heading towards the much awaited negative yielding US Treasuries? It's like an unrelenting bid that keeps coming in, whether it's safety, trade, tariffs, Powell. There's always reason to buy US bonds.
Yeah, that's right, Oliver. I think that's what the Fed was trying to do, is their ounce of prevention. They see that the yield curve inverting as a big sign for potential recessions. What I'm looking at is actually not the 3-month and the 10-year, but really the 2-year, the S&P 2-year Treasury Index and the S&P 10-year Treasury Index. That portion has not inverted, and that's a little bit more of a stable measure of the yield curve. In 1994, Greenspan cut rates before that measure inverted to some successful extent. I think that when you look at this ounce prevention that the Fed is performing here, is trying to prevent that yield curve inverting any further. What we see now is whether that's going to work. In the 90s, Greenspan cut rates 23 times to extend that previous longest bull market in history. Now we have the longest bull market in history in 2019. The question now will be, can Powell stay ahead of that? That's really what the bond market's struggling to work with, and what we're seeing from the standpoint of the 2-year and the 10-year perspective.
Now, Brian, the question that I keep coming back to is, all right, well, does this yield curve inversion still carry the same power that it did in the past? I mean, I don't think anybody is really wants to go up against its record, but a sample size that's fairly limited, and a environment now that we see this week where both the deep kind of bears are buying bonds, the bulls are buying bonds. Nobody in the world seems to think there's even the slightest chance of any inflationary metrics. So is there any risk in Powell believing it and acting very literally based on it?
Yeah, I think while it worked very well for Greenspan in the 90s, it did not work in the 2000s. So it remains to be seen. And when you look at the jobs number, last week, 164,000 jobs. It's not a bad number. The revision of the previous months now puts it 2 months in a row below 200,000 in terms of jobs creation. Another point, though, was the inflation measure. The Fed has been talking about muted inflation measures, and they see some uptick in wage growth from the jobs number last week. That's another question as to whether they can continue on with the policy.
Is there a now expectation that is gone too far sort of by the bond market? Some people call it the bond vigilantes, right? Because now I constantly hear this description of deeper inversion as directly equating to more cuts, right? We have a tariff tweet that goes off, everyone rushes into treasuries. Now suddenly we went from questioning cuts to come after Powell's commentary to thinking 3 or 4 cuts. I mean, does it work that literal where, okay, now we're X amount of inversion, we've got X amount of cuts coming?
Yeah, with Jerome Powell, I think he spoke loudly and carried a small stick, did not follow Churchill's advice there, and that's how the market reacted to it. I think that Greenspan, he earned the nickname of the Maestro because he was able to raise and cut rates throughout that 90s, that elongated bull market. You saw that multiple moves were taken during that time. It wasn't just more of the easing cycle or tightening cycle. It's been over 10 years since we've seen any cycle beyond QE and twist. So that's what's really going to be focusing on. It is amazing to me when I look at the S&P Global Bond Indices, and you look at all of the performance across the board in fixed income, and I'm not just talking about here in the United States, but Europe, Latin America, Asia, all across the board on a month-to-date, year-to-date, year-over-year basis. We're seeing a lot of green in terms of the performance there. Over a year ago, we almost had yields that were about double where we are now. So right. Yields are now below 2% across the board on the Treasury side on 10 years. It makes it very difficult for the bond vigilantes to be able to come around this time.
So this is interesting, and we're looking at some of the flow data here year to date. Obviously, there's been, over the past quarter, we still see a push into the bond market. $2 billion that came into LQD last quarter. Brian, with the amount of money that's flown into bonds as that yield hunt, someone described that as speculation more than the bond market experienced in the past. If investors are speculating on the price they're going to be able to resell that bond for, does it make sense then that maybe the bond market would swing with a little bit more volatility. I come back to that old saying, right? People go, bonds are smarter than stocks. Are they that much smarter anymore? Is this what Powell's trying to, grapple with right now?
I mean, I think he's taking his clues from the bond market, but to your point, we do see a lot of flows into fixed income, particularly in the passive space. 120 billion in passive flows year to date this year into fixed income alone. That nearly matches the amount of flows for all of last year. So why is that? You look at the S&P US Aggregate Bond Index, that's up 8% year over year. It's bettering stocks right now. There's a lot of ways for investors to get involved, and clearly Treasuries are winning right now with this risk-off sentiment. But we're seeing strong gains across all of our indices that we measure and calculate.
Yeah. Okay. So when we think about where we go next from here, the consensus seems to be there's no limit to negative yielding assets. The consensus seems to be there's no bottom in the 10-year. What will you be looking for to see if that's not the case, Brian?
I mean, I think the question is what's attractive for investors, and where is a good safe haven investment for investors. When I look at the sub 2% yielding world, what comes back to me is the S&P AMT-free Muni National Bond Index. That's a municipal bond index that's yielding under 2%, but on an after-tax basis, you're going to get that tax benefit. It puts you up over in the mid 2%. So unless you're looking to get something a little bit more, such as a 6%, you'd want to look at the S&P Preferred Stock Index or the S&P Leveraged Loan Indices. Those are a little more risky from the credit standpoint, but from a flows perspective, we're seeing a lot more investors chasing into passive investments. We're seeing the winners in the sovereign space, Treasuries, U.S. investment grade, a little more of those traditional fixed income asset classes.
Okay. Now, when you talk about the credit market as well here, the corporate bond side, I want to go there for a sec because we did have a little bit of widening out of credit spreads during this event the past couple days. We look at the past year, and we still obviously have not had any big blowout on credit spreads, Brian, but we also never really came all the way back in after last quarter. It was kind of like that event did expose maybe slight cracks because that BAML OAS spread we look at a lot didn't come back to where it was, as we see here on the chart, pre-Q4 sell-off. So are we starting to trend higher for credit spreads in this market, do you think?
Well, I think we've done a lot of research, and in fact, my colleague Kevin Horan did a nice piece that correlates the high correlation between high yield indices, high yield spreads with the stock market performance. They are correlated to that extent. To the extent that the stock market loses favor, some of those high yield and lower investment grades type of products are going to be adversely impacted by that. We haven't seen that spread widening that we saw in the fourth quarter of last year. We're starting to see some of that right now, and I think that's what's also the flows have shown moving into some of the more safe haven products, such as the S&P US Treasury Index, the S&P US Aggregate, and investment grade corporate bond indices.